Well, hello and good evening. This is Jay from Prosper Capital. It is 8 p.m. on Thursday, August 6th. So we will get started. Coming back to you all with our monthly webinar again. This month, our area of focus was investor mindset. And the main reason for picking up this topic is because there is a lot of fear in the market and it is pretty confusing as to what to invest in and what should be the investment strategy in today's economic and market cycle. So we thought that this might be an apt topic. Not saying that this is right or wrong, but this is kind of the mindset or the strategy that we are adopting to further our investment journeys. And it's also driven or inspired from some of the other seasoned investors that we know very closely who have been investing pretty much full time for 30 plus years. So they have seen the ups and downs of the market. They have seen the 2002 dot-com bubble burst. They have seen the 2008 crash. And it's always good to kind of get some information and learn from their experience. So with that being said, who is this presentation for, or the target audience? I would say if you're an active investor or passive investor, if you're starting out or a seasoned investor, I think you all would find some value in this. The first few slides are primarily focused on the mindset aspect of it. The middle portion of the presentation is more about really a refresher or reminder about why do we invest in real estate to begin with. Because a lot of times when the market tanks, we tend to forget some of that information. And then the last two slides is really, I guess, what I would call the money slides. So my goal would be to go relatively quickly through some of the content that has been spoken before about why real estate and focus on the first part of the presentation and the very last part of the presentation. But in the meantime, if there are any questions, feel free to drop them in the Q&A box or the chat box. This presentation is being recorded, and any information presented in this webinar is for educational purposes only. So make sure to check with your CPA and attorney before making any investment decisions. Quick info about us. These are basically my partners, DJ and Andy. I lead acquisitions for Prosper Capital. Andy leads investor relations, and DJ founded Prosper Capital about 8 years ago, and he leads all the operations. So he also oversees the property management company, the construction side of things, and that way we keep essentially all parts of the business in-house, and we are fully vertically integrated company. Again, a little bit of an overview. We have roughly around a little over 600 units under management, no loss of capital, no capital calls. Of course, right now is not the best time to sell properties, but all of our properties, we have no exposure to bridge debt. So we have all properties under long-term debt. Our current strategy is keep on holding them and ride it through this current difficult market cycle, and then eventually sell the properties when we recover from the market cycle that we are in today. Overall, we are fully vertically integrated, which gives us a little bit more control than someone who uses third-party management, et cetera. Including asset management that we do in-house, also leveraging AI and Claude, some of the cool stuff that we are doing. We are inaugurating our head office here in Covington. A lot of you may have received some invites for those as well. So if you're local to Cincinnati, would love to see you towards the end of the month for our office inauguration as well. All right, so with that being said, the very first topic that we're going to talk about, and this relates to really the mindset piece of this puzzle, is there are really 6 human needs. These 6 human needs drive every person. Now, one of these needs is stronger for someone as opposed to the other, but all human beings are driven by these 6 human needs. Number 1 is certainty. We like to have certainty in outcome. We like to have certainty in our market cycles and economy. And unfortunately, that is one thing that is completely absent in today's market cycle and economic conditions, and even in the geopolitical and macroeconomic landscape. One thing that we don't have is certainty. Like with the Iran war, we have the ceasefire one day and the deal is signed, and then the next day we are back at war, and nobody knows what's going to happen with the price of oil. lots of moving parts. Interest rates are continuing to tick up. Since March, interest rates are up by 75 pips. So we really don't know where we are heading, if it's going to get better from here or if it's going to get worse from here before it gets better, right? Variety. We like to do a lot of different things, which is why you'll see that a lot of people, they get bored with a certain asset class. They'll get bored with multifamily, then they jump to industrial, then they get bored there, and then they go to office and retail. They get bored with real estate, and then they start chasing AI stocks. So human beings in general like variety, but unfortunately, if you want to get good at something, you got to focus on your lane. And regardless of the market cycle, you got to stay in that lane so that when the markets recover, you can recover with that market cycle. And by the time recovery is here, you're one of the best operators or investors in that asset class, and you know that asset class better than anybody else. And that's how you win. Number three is growth. We are all driven by growth. I can totally attest to it. This year, even the tail end of last year, we haven't closed as many deals as we would have liked to. And it is frustrating. We don't feel like we are growing as fast, but I think growth with stability or consistency is the key. If we can find consistency in numbers and projected returns, then it is better to slow down than grow. But growth is really one of the 6 human needs as well. Significance, or the need to be recognized. So that's one of the key needs. Some people are driven more by that than others. Some people are a little bit more humble, but everybody wants a little bit of recognition. If they did something that was great, you want to be recognized for it. You have that need for significance. And I'll tell you that as sponsors right now, we feel pretty small, because no matter what we do, it seems like everything's working against us. Connection is basically the human connection or the network. We all know that's a human need. We are social animals. And then finally, need to give back and need for contribution or altruism. And that's really like, if you have something to give back, you've done well in your life financially or from a knowledge standpoint, it really gives you happiness to contribute that knowledge to the next generation and give some of that wealth away to people who are in need. And that really drives your overall happiness level. Now, the next slide I have here is really about getting control over our time, because as investors, again, sometimes we are totally at fault of chasing shiny objects, and we also start chasing low value activities that really create a time suck. So essentially, as long as we follow some sort of a framework to only focus on high ROI activities that can help us create the best possible impact. Now, this is not just true for investors, that's really true for everyone. But in general, you would see that successful investors and entrepreneurs really get this very well, and they outsource, delegate, or eliminate anything that's a low value task. A great resource and a book on this topic would be Buy Back Your Time by Dan Martell, where he proposes lots of phenomenal ideas to outsource low value activities. And one of the exercises that we as a team did was we went through our calendars and we color coded all the meetings that we had on our calendar. And anything that was in the gray or blue zone, we actually cut the time of that meeting in half, or we outsourced those tasks and canceled those meetings and kept only the green and gold, the high value meetings and conversations, anything that drives our strategic direction, our meetings that are with our investor partners and brokers and some of the other friends, we keep that on the calendar, while any meetings that are with people who don't add any value to your life and actually are a negative influence, you eliminate those meetings, so on and so forth. So creating a massive action plan is all about recognizing that what adds value in your calendar and eliminating everything that actually destroys your productivity. Now, taking control over your time, again, essentially, what it means is the way we color coded our tasks was anything that was high lifetime value, meaning it creates an impact that's going to pay dividends lifelong. That could be, examples would be relationship building. You invest in good relationships, those are going to pay its dividends, and it's going to make your life more fulfilling, reduce your stress levels. So that is gold time. So any time invested in relationship building, improving our knowledge, spending time with family, all of those things, we put those in high lifetime value gold time. Green time was everything that was business related, analyzing deals, raising capital, doing property walkthroughs, underwriting, meeting with a network of lenders and brokers. Anything that helps the business is the green value time. Next was blue time, and that a lot of the blue time activities can now be automated with AI. So bookkeeping, building reports, a lot of that stuff can be automated using really with Claude, also with ChatGPT and some of these tools. So one of the examples which was really important but more labor intensive was actually data tracking and asset management. So what we did was my partner Anthony, who's phenomenal with AI and building tools using AI, basically used Claude and automated all our dashboards. So now these dashboards, which used to be Excel based, where we used to export everything from AppFolio, which is our property management system, everything is now automated. Integration has happened through Claude, so we don't need connectors like Zapier. It's a lot easier. It's real time. And these dashboards are in our office for property management team, construction team, and the investment side of the business. So we have real time intel from what's happening in our business, which is actionable intel for our team. So as an example, how long it's taking to turn around our unit turns, ROI on the unit turns, how long is our average ticket open on maintenance, what is the ticket reopen rate? Like once we have closed the ticket, are we having to open that ticket again? All of those things in real time are being tracked. So those KPIs are being automated and tracked. So that was blue time. It was a lot of labor intensive work. So we just automated that, put that on the bottom of the pile. And gray time is truly, you still need that time because sometimes you need that time to de-stress, and that is watching TV or browsing a little bit of social media. But as long as you're not overdoing it and trying to minimize that time, keeping it to maybe 30 minutes to 45 minutes per day, and not doom scrolling for 3 hours at night before going to bed, all of those things were we dedicated in that, and we kept ourselves accountable through Habit Tracker, which was a tool that we are using. So we can see not just between us partners, but our close group of friends, we actually see each other's habits and how many boxes everybody's checking every day in terms of healthy meals, time allocated to different activities, working out and stuff like that. And that has become really a game changer for us in terms of habits, but also that is impacting our mindset. Because if we show up with a positive mindset, other people see that, and naturally things just start flowing and you get more deals and the business improves and all of that, right? Now on this slide, and if you guys are Tony Robbins guys, you may have seen some of this stuff, because some of this comes from Zig Ziglar, some of this comes from Tony Robbins, and Tony Robbins likes to also use a lot of Zig Ziglar stuff. So this is not something brand new. This is all recycled stuff, but the stuff that we've found helpful ourselves internally as ourselves and also for our teams, that's the stuff that I put on these slides. So 4 classes of human experience, going from class 4. Class 4 is the stuff. Does it feel good? Not so much. Is it good for you? It's not. Is it good for others? Nope. Does it serve greater good? Not really. So these are the types of things that are truly a waste of time. But sometimes we still do it because it maybe helps you distress, and that's like doom scrolling on social media, for example. You got to minimize that as much as possible. Now, class 3 is a little bit better, which are the activities that make you feel good. Are they good for you? Not necessarily. Good for others? Nope. Serve greater good? No. And this is also something that you should potentially minimize. Now, an example might be eating ice cream. Eating ice cream makes me happy. I love ice cream, but I know it makes me feel good for the 30 minutes that I'm actually eating ice cream. But other than that, it's really not good for you, right? So that is one example that comes to my mind. But we can probably think of several other examples that fall in that bucket. And most people, majority of the people, actually spend all of their time in class 3 and class 4. Unfortunately, that is the reality, right? Now, class 2 are the activities that don't feel good, but they are good for you. They are good for others, and those activities do serve greater good, right? And I mean, some of the examples could be like working out. It's good for you. Is it good for others? Well, that's hard to argue. But maybe if you're working out, you're motivating your spouse and your kids. So I guess I would say it is good for others too, and it's overall good for it's greater good too, because as a population, if you're healthy, fit, and more productive population, we are going to be a more successful country than any other country on the planet, right? So that's one example that comes to my mind. But even overall, for a lot of people, volunteering, for example, doing some landscaping work in the parts of city that need some help. Well, is it the most fun thing to do? It's not for a lot of people, but it is great for the society. It's great for other people. So doing something that has positive impact on the society, although you personally don't enjoy it, is still a great thing to do. So that's, you want to maximize kind of class 2 and class 1 activities. And then class 1 activities is the activities that feel great, they're good for you, good for others, and serve greater good. And usually these are the activities that truly align with your calling or your purpose. So once you find those activities that align with your calling, they're usually good for you, they're good for others, you're creating a positive impact, and they feel great. So you can keep going. And those are the activities that you really want to maximize. And again, this is kind of tying in with mindset. It has nothing to do with real estate only, but this can apply to no matter what area of expertise you're in. If you're a doctor, an attorney, if you're an investor, or a W-2 employee, regardless of what part of journey you're in, this is going to be applicable for you. And the reason why we are talking about mindset today is because mindset and education about investments truly creates the investor mindset. And I think having the right mindset plus having the right education collectively is going to be very important if we want to survive through this downturn. And we already feel like it's pretty bad right now. But if I'm following a lot of the economists and people, big names, Jeremy Grantham and Ray Dalio, I mean, all of them are saying it's going to get worse, right? We'll find out, but these are some really experienced people, and I like to hear what they have to say. So your thoughts is where it all starts. Your thoughts become actions, and your actions become your reality. So essentially, this is kind of the chain of your thoughts converting to your results. So thoughts convert to your feelings. How you feel drive your emotions drive your motivations, which then drive actions. And then finally, actions drive your results, which is why I think dwelling in the right thoughts, and even if you're having a hard time with some of your deals, hard time closing deals, all of that, you want to focus on the positive and see where you can make impact. And even if you can't do a lot right now, you can always spend time learning from others, talking to people, and educating yourself. So as long as you're dwelling in the right place when it comes to thoughts, you will see positive returns. Now, this is something, again, pretty repetitive if you're an investor. But I like to, again, jog everyone's memory on the cash flow quadrant, especially for people who have not seen this before. This is one thing that completely changed my life and moved me from a W-2 employee to a full-time investor when I truly understood, how money works and how capitalism works, how this country works, right? America is all about creating value, and people who create value and build assets get compensated for it from the tax code standpoint and also from overall wealth generation standpoint. So if you're in the employee quadrant, you have a job, you're trading your time to get that paycheck. From the employee quadrant, the one step next is really self-employed. Now you work for yourself. You're still trading time for money, but you don't have a boss. You have a little bit more flexibility. And usually you're still creating some sort of a business, which in itself is an asset. And you can deploy some tools, have a small team where the business starts to kind of run by itself, where you create some sort of a leverage. After that, you go into the true business owner or entrepreneur quadrant, where you have a team, you have systems and processes built out. Those teams of people, the systems, those processes are working for you. So once that is built, you might be able to run the business with 5 to 8 hours of your time committed, every week, towards the business, while the business is still generating returns for you. And then you can deploy some tools, have a small team, you have systems and processes built out. Those teams of people, the systems, those processes are working for you. So once that is built, you might be able to run the business with 5 to 8 hours of your time committed every week towards the business, while the business is still generating returns for you. And now you have greater leverage. You're leveraging other people's time, you're leveraging your capital, you're leveraging systems and processes. And the more things you're leveraging, the better it is for you. So if you look at originally the pyramid of leverage, how it worked, um, initially people used other people or labor as a leverage. After labor, it was really machinery that was used as leverage. After that, it was capital, when Rothschild and all these people in the banking era created all their wealth. After that, it was content, the generation of YouTube and Instagram millionaires leveraging content for value creation. And now it's really leveraging code or AI, automated code for wealth creation. And the more things you figure out to leverage, the better it is for you, because you're buying your time back at the same time increasing your net worth and wealth. And then finally, investor. In this quadrant, you're truly only using your capital to create more capital or more money, and you're not really leveraging much of your time at all to create more money. And you're basically investing in assets that continuously keep paying you, and those assets and the cash flow from the assets continue to pay your liabilities. On the flip side, we see, like, I'm guilty of this. When I was an employee and a W-2 earner, I was actually trading my time for money and using that money to buy more liabilities, buying houses and cars, and increasing my bills. And that's what keeps you broke. That's what keeps you living paycheck to paycheck. And if you want to break out of that cycle, the only thing that can help you is buying assets or starting businesses, right? So now, having spoken about like the mindset, why it makes sense to start investing. Now, what you invest in is completely your preference. For us at Prosper Capital, and for a lot of my network, the vehicle that we have chosen is real estate. But at the same time, I'll be honest, we don't only invest in real estate. Although majority of our exposure is in real estate, we are still diversified. So diversification is definitely one of the keys, but real estate is one of the safest investment vehicles or asset classes. I know some people may beg to differ right now, because in a bad economy or in a downturn, none of the assets seem like a home run. There was some time up until a few months ago where the Bitcoin prices were just going through the roof, and real estate prices were actually declining. They have been declining since 2022 when they peaked, and everyone looked like a rock star who was investing in Bitcoin, and they were making money without really lifting their finger. And in real estate, we are, taking care of these properties, working every day, day in and day out, and the returns were still diminishing, and we looked like complete losers. But then the Bitcoin prices dropped, and now it's the next shiny object, which is AI stocks, and that's where all the capital is flowing. I would say that on the flip side, the reason we like real estate is because it's tangible, it's a solid asset class. Once your money is parked in it, and if you're not overly leveraged, it is by far one of the safest asset classes to at least protect your capital. So even if you're not doubling your money every year, which it will never happen, there are going to be market cycles, at least it is a very safe asset class to park your capital and to protect your wealth. So real estate, as FDR said, cannot be lost or stolen, nor can it be carried away. Purchased with common sense, paid for in full, and managed with reasonable care. Sorry, there's a typo there. It is about the safest investment in the world. And I think we truly firmly believe in that, even in today's market cycle. So again, I put a subtext here, a reminder, because a lot of us, we already know all of this, but sometimes it is good to refresh our memory to see, hey, why did we start investing in real estate in the first place? Because when, economy like today, we tend to forget that, and we start to chase the shiny objects. But we got to keep remembering that, so that, these are the benefits, intrinsic benefits that real estate offers. And in the long run, as long as you're patient enough, it will definitely pay those dividends, and you will enjoy these benefits. Passive income is one of the major benefits. Now, right now, I understand that the cash flows and passive income is pretty small with today's interest rates and the rents not going up and stuff like that. But again, this is not forever. Things are going to change for the better. So what goes up comes down, and what comes down goes up eventually. It's all about patience, building resilience during recessions. And in a market cycle like today, even though things are not all hunky dory, the assets that we have, which are stabilized, are still cash flowing, and we are still doing distributions for our investors. And that's a very good example about resilience during recessions. So sure, those cash flows are not exponentially going up right now, but we are maintaining those cash flows. I don't know a lot of other asset classes where you are getting those cash flows or repremiums. Leverage tax benefits, which continues to be one of the major benefits of real estate, with cost segregation, depreciation, paper losses to offset your other income, and capital gains taxes, and other benefits like 1031 exchanges and other ways to defer your taxes. So, tax avoidance, of course, is illegal, but tax deference is a big benefit, legal benefit that real estate offers you. Preservation of capital, again, that is key, but it's true with a caveat if you are not over leveraged. If now your loan is actually higher than the property value itself, well, you've wiped out your equity essentially. Now, in this case, if you foreclose on the property, you didn't preserve capital. So that has happened. It is happening even today in many markets, not so much in our market, because if it did happen, we would get some sweet deals. But we are seeing it a lot more in markets like Texas, Phoenix, Florida, Arizona, because people overpaid because they were hot markets. And in those cases, preservation of capital did not work out, which is why we try to stay around 70 to 75 LTV on our deals and not be over leveraged. And as you pay down that principal, and if you have assets that are 50% paid and your leverage is below a certain threshold, it is by far a pretty safe investment vehicle and asset class to be in. And then finally, forced appreciation. And that forced appreciation, I mean, this goes both ways. For example, the deals we bought in 2021, 2022, even if we doubled the NOI, the asset value is about the same that we paid for the asset in 2022. So the forced appreciation did not work out, even though NOI increased and we improved the asset significantly. But you have to understand that forced appreciation, to make sure that that works, the market has to favor it as well. So if you are in a position where you're forced to sell in a market like today, you're not going to realize forced appreciation. But if you are able to hold in a market cycle like today, and maybe in 2 to 3 years once the market recovers, at that point, if you sell, now not only is the market helping you, or even if the market stays flat and you have improved the NOI of the property, you are going to get that forced appreciation through value add and better operational efficiency. Now, having said that, moving to like why multifamily, again, this is a repeat from the second webinar that we had done about why multifamily. I just thought of retaining this slide again as a reminder. A lot of people are fleeing away from multifamily, but none of this has changed. Even though the market cycle has changed, all of these benefits still hold true. Multifamily is a basic human need. It produces cash flow, although cash flow is dwindling or evaporated in some cases today. But in the long run, it still is a cash flowing asset. Mortgage pay down, so at least the rent that you're collecting is helping you build equity in the deal, because those rent payments are paying your mortgage principal down. The forced appreciation or strategic forced appreciation is something that we just talked about. And then hedge against inflation is typically because with inflation, typically rents also go up. Okay. And I again say typically because right now inflation is 4%, but the rents are going up by about 2 to 3% in this market. In many markets, rents are flat or even declining. So again, those short-term blips could happen, but if you're looking at a deal from a 7 to 10-year timeline, you will notice that the rents do go up on that 7 to 10-year timeline. And typically they go up at least to match inflation, but in most cases, the rents go up or they exceed the rate of inflation. So in the last decade, in Cincinnati, at least, the average rent growth was actually in double digits, about 11 to 14%, depending on the neighborhood, while inflation was still about 3%. So definitely the overall 10-year average very handsomely beats inflation. And then finally, tax benefits that we spoke about, not unique to multifamily, but kind of true for mostly all real estate, but especially commercial real estate. Now, the last two slides, which I said, I think are kind of the money slides in terms of what we are seeing and then what we are doing about what we are seeing. So I don't think this will need the full 1 hour for this webinar, so we'll be keeping last 15 minutes for Q&A. But overall, what are we seeing in the market today? Rents are flatlining or declining. We all know that. Any properties that we have invested in, this is kind of true across the board. We are seeing this here in Cincinnati, in Columbus, in Lexington. We've got a property in Bloomington, Indiana, which is a college town. So usually college towns are evergreen, but rents are flatlining there as well. Concessions are increasing, not in the Midwest that much, because we don't have to really deal with oversupply to the extent that some of the other markets like Austin, Texas, or Phoenix, Arizona had to experience. But a lot of the construction that started in 2022, 2023 of these massive 300 and 500 unit apartment complexes is now all coming online in the last year or so. And that's really driving the pricing down. Some of these apartment complexes, the worst I've heard is 6 months of free rent in a Class A apartment complex in Phoenix, which is mind-boggling. And you're actually getting, I mean, the residents are getting a Class A apartment complex or apartments for prices cheaper than B and C class apartments. And that's putting downward pressure on B and C. And it's driving a lot of Class C operators out of business for that reason. Interest rates or cost of capital has been increasing. We thought we had plateaued for some time there earlier this year, but then steadily the market is demanding more returns on treasury bonds or T-bills because of the Iran war and kind of the crippling faith in American dollar, because our spending keeps on increasing, and then as compared to our GDP, on top of that, now we have the Iran war going on. So people are on the grand scheme of things, on the world stage, people are beginning to question if we will ever be able to repay our debts. So because of that, there's definitely some questions in the macroeconomic scene. I think if the war is under control, and then if the inflation is under control, we should start seeing some of these interest rates come down. Again, earlier in the year, we started seeing that a little bit, but then it just got worse since then. Cap rates or capitalization rates are expanding. Even in Class A minus neighborhoods, I was actually just trying to get some BOVs for some properties that we were just kind of casually considering selling in Class A neighborhoods. We are not able to get any offers or any BOVs under 7 cap or even 7.25 cap in a Class A neighborhood, which underwriting some of these deals 3-4 years ago, that was being overly conservative because deals were trading in high 5 caps in the Midwest, and in Texas and Austin, I've seen deals trade in the 3s cap rates, like 3.1. I've seen one deal in Austin trade at 2 cap. So it was that the cap rates were that compressed. But when the interest rates increased that rapidly within a course of 12 to 18 months, and they basically doubled, obviously the cap rates were going to follow with the cost of capital going up. So not really surprising at all. But if you bought a deal in 2022 at a 6 cap, improved the performance, and today you're forced to sell it at 7.5 cap, all your work has gone down the drain, and you're just fighting to even just save investor capital, right? But that's how market cycles work, unfortunately. Cash flows are declining because the rents are not going up, but everything else on the expense side of things is going up. Taxes are going up. We just got reassessed in the Montgomery County, which is like the Dayton submarket, and the taxes have gone up 40 to 50%. All the rents have stayed flatlined. Insurance premiums are going up. That's not horrible in our market in the Midwest, but in Florida, some of the coastal markets, insurance continues to pose headwinds. So the pricing is going up. Cost of labor materials is elevated, but rents are not going up. Thus, cash flow is declining. And because of all of this, cap rates going up, interest rates up, expenses up, your asset values are falling down. We are all seeing that, which is why I would say if you're not forced to sell in today's economy, it would be wise to just hold until we see some positive signs in the economy and the investor confidence is bolstered. Right now, there's definitely a lot of fear in the market. And the worst time to sell is when there's a lot of fear in the market, because you would have to accept pennies on the dollar. ROI on renovations are going down. So we specialize in value add deals. Even to this day, in today's economy as well, we are still looking at value add deals. And the reason we look at value add deals is because you still have an opportunity to force increase the value of the property. You're not completely at the mercy of the market. There are a few levers that you can pull to improve the property and add value to the property. But initially, when we started investing, or when I started investing in 2019, I was able to invest renovation dollars. If I would put $10,000 in a unit, my rent would actually go from 800 to 1600. And that's why within a year, you would be able to do a full cash out refi. And that's when it was like hitting the lottery. Like, oh, this is just too easy. And you rinse and repeat. And that BRRRR method was becoming increasingly popular, and that's when it became so popular. But burring your way out of renovations is getting harder and harder. So we were seeing minimum 30% ROI on renovations. Now that's down to like 15. Now 15% ROI on renovations is not a bad number, but it's definitely a lot lower than a baseline of 30. We used to see 30 plus 50 in many cases as well. So that's definitely declining, again, because the funds you're borrowing for renovations, the cost of those funds has gone up, cost of renovations has gone up, but the rent premiums you're getting post renovations has gone down. So, which is why your ROI is pretty horrible right now. But that still pays its dividends in the long run. So if you improve the property today, maybe you're not getting an immediate ROI, but now you have an improved property. 2 years from now, once the rent start to go up again, it will pay its dividends. So which is why we are still improving our properties, because being slumlords is really the worst thing you can do for your properties, for your residents, which are your paying customers, and thereby that is the worst thing you can do for your investors. Increasing geopolitical and macroeconomic risk. We are seeing the whole thing with Iran war. We have, crossed off some of our really close allies, and we'll have to improve those relationships with some of our allies as well. China continues to be a threat. It's a booming economy. One of the things after Iran war was oil prices, and everybody thought that it's going to shut down the world with oil prices going through the roof. But if you've noticed, actually, oil prices did not go through the roof. They definitely did go up from about $2.5 a gallon to 3.5 here in the Midwest. But it was not as bad as a lot of the economists thought of. And the reason for that was China actually cut its oil imports by roughly about almost 70%, which was mind-boggling. And that also tells you that they are definitely developing their economy to be less dependent on foreign oil. So that also continues to be one of the aspects where China is becoming definitely a key competitor in the world economic scene and continues to pose a geopolitical risk to the US. And then finally, national debt is definitely one of the things. We have to hopefully get that a little bit under control. There are some sneaky strategic moves that I think we are planning. It's yet to be seen, to hopefully reduce some of that economic debt that we have on our country. But all of these things create more question marks in investors' minds when capital has to move to the US in form of treasury bills, US treasury bills. In short, it seems like it's all gloom and doom. But I would say that when it seems like it's all gloom and doom is actually typically the best time to go in and buy. So what goes up, like I said, comes down, and what goes down comes up. So in this type of economy, patience is the virtue. It is the most difficult thing to do when we see asset prices crashing. And you wouldn't believe how many calls I get every week from our investors that they're just asking us to sell some of the assets. But selling assets right now is truly the worst thing that you can do. But that is just in general how human beings are wired. When prices are coming down, you panic sell. But that is really the worst thing you can do. And the new shiny object is the AI stocks. until the music stops and the bubble bursts. AI definitely is a bubble. If you look at what the AI stocks are trading for versus the actual profitability of those companies and actual value those companies are creating, there is absolutely no correlation. The PE ratios are out of whack completely. Now, some of these AI companies will become home run stocks and they will, mint more millionaires than we have ever seen. But a lot of them are also going to be carcasses along the way. And if you are a primary investor in one of those companies that now is a carcass, you're going to lose your livelihood. And this is kind of exactly what we saw in the dot-com bubble burst. Internet didn't go away, dot-coms didn't go away, but anything that had a dot-com in front of its name was getting crazy valuations in around 2000, 2002. And many of those companies failed. But at the same time, companies like Amazon and unicorn companies were also born at the same time. So it's going to be the same with AI. If you're lucky enough and smart enough to find and stick to those rock stars, you will do really well. But most people, by the time most people know about some of those rock star stocks, it's already too late. So that's kind of what we are seeing in the market today. And I would, love to kind of hear your thoughts on this as well. But now, based on what we are seeing, what should we do in that case? Because everything kind of seems pretty negative. And here's kind of how we are approaching the situation right now. First and foremost, we have to take action. I mean, sitting on the sidelines is really a guarantee to lose. You're going to lose to inflation. You're going to lose on the upside on any possible assets that you can buy today at a discount. So being safe and not investing, sitting on the sidelines is the only way that's going to really hurt you. Diversifying is a really good strategy right now. Now, of course, Warren Buffett says that diversifying is for losers. It's for people who don't know what they're doing. Sure. Now, if you have some sort of a back end information about a certain company that is severely undervalued, well, I would put all my money in that company if I know the leadership of that company. I have full faith in the leadership. I truly know what that company could be worth someday, and if it's truly undervalued. Well, most people don't have that type of an insider information. So having knowledge and information of publicly available data sources, the best thing that you can do is diversify your investments across stocks, bonds, and even within stocks, really more like index funds. So you have a diverse exposure across the entire stock market. A little bit exposure to international markets as well would be a good idea. Real estate, precious metals, and commodities. Commodities, especially because when things get really rough, commodities is what you need to survive. So in those cases, which is why you see that in war-like situations or when there are significant fears of a recession, you will see the commodity stocks go up. Crypto, although it has not been doing so well in the last 6-8 months or so, it still stays about 1 to 2% of my portfolio, and it's not a bad idea to have some of your wealth, not majority, but a portion, maybe about 2% or so in crypto, because BTC has some intrinsic, Bitcoin, Ethereum, some of these cryptocurrency have some intrinsic benefits, like you can't make more of them. There's a limited supply. So it is kind of like the digital gold. And then finally, private equity, which could be slightly higher risk, but high reward investments, investing in the right businesses. A lot of folks don't have access to those types of investments. But if you're lucky enough to have access to some private equity investments or venture capital investments, that is another area where you could invest. Staying consistent with investing is going to be the key. If you try to time the market, it really never works out. I mean, timing the market doesn't even work out for Warren Buffett or Benjamin Graham, some of the best investors known to mankind. Even they don't time the market. So you have to just be consistent with investing. I like to dollar cost average in some assets where you can dollar cost average. Now, I cannot dollar cost average into real estate, because when you do a deal, it's going to be a $50,000, $100,000 check size. You cannot put a dollar in a $10 million deal. But when it comes to buying stocks, buying Bitcoin, I've set it on completely automated where I invest $100 a day in crypto, $100 a day in stocks, and it's just automated index funds. So I know that I'm buying at the lowest of lows, and I continue to buy as things improve and continue to go up. Thinking long term is going to be key. I think this is true with no matter what asset class you're in. Thinking long term is important for stock market too. Thinking long term is equally important in real estate, because if you invest in long term assets, a good asset that has good bones in a good location, and if your plan is to hold it for 7 to 10 years, then a 2 to 3 year time in that 10-year plan that's reflective of the economy that we are seeing today should not really bother you. Because if you have a 10-year plan, usually you never see that in the 10-year plan, during the entire duration, the rents are going down or you're not getting any value from your investment. The other benefit is I know some of the local real estate investors who have held these assets for 30 plus years. And I was talking to some of them, and when they bought these assets 30 years ago, they felt like they severely overpaid. But if you look at what they paid back then and looking at the asset values today, uh, saying that they've done well, even if they have to exit today, is an understatement. I mean, they have done phenomenally well. The only thing that worked in their favor was one time, 30 years of patience and good operations during those 30 years. Of course, you can run the property into the ground or any investment into the ground in those 30 years, but knowing how to operate and having the patience to hold, those two are really the key things. Don't panic sell. I mean, right now, like I said, we are getting a lot of pressure from our investors that, oh, the cash flows have gone down. Maybe we should just sell. Well, we are, after all the work that has been done over the last 2 to 3 years on a certain asset, for example, there's no reason to panic sell when the markets are dipping. Don't be over leveraged, having some control over debt and not taking too much debt, and making sure your DSCR numbers or debt service coverage ratio, that number is conservative enough, and the property is able to service the debt, produce cash flows, and also produce enough return to have healthy reserves to weather the storms. Have enough liquidity to weather the storm. Cash is king by the end of the day. I recently heard this saying, what was it? Net worth is vanity. Equity is sanity and cash is king, something like that. I might not be 100% correct on that, but cash is king. We all know that. And if you have cash to survive, our goal with all our properties is about 6 months of PITI, which is principal, interest, taxes, and insurance. So that's always been our thing, that we hold about 6 months of PITI payments in a reserve account to weather the storms. We recently changed that to include CapEx and R&M of worth 6 months also parked in that reserves account, because things are definitely getting more difficult, and having as much liquidity as possible is always a good idea. Being greedy when others are fearful, which is why we are aggressively chasing deals right now. Because this, I think, is a good time to really start to look at deals. The feedback I'm getting from a lot of brokers is the offers are coming in a lot lower than the whisper prices. And that is really when you should be really hunting for deals. Now, just up to a year ago, offers were landing a few percent above even the asking price or whisper price. And there was a feeding frenzy and bidding war on any deal that was on the market. It's the opposite right now. So if you are finding some properties that have some level of distress, I think it is a great time to go in and swoop up some of these really good, solid properties in good locations and hold them long term. But to do all of that, you need partners who buy into your vision, who believe in what you believe in, who can see 7 to 10 years from now what that property or asset is going to be worth, who believe in that same business plan. And having those types of partners with the same mindset and same business plan and same vision is going to be key for operators to have successful acquisitions. So finally, it's time to own your future. I think being scared and being impacted by the fear that we are seeing in the market today is not a good idea. Now, obviously, considering the fear that's in the market today, personally, it's a good idea to hold liquidity as well. But I would say that anything outside of your rainy day fund, now is the time to go ahead and invest all of that capital in really good quality assets. Because after a long time, these assets are finally available for sale at a reasonable enough price. So I think now is the time to really move. So that's kind of our take in today's market cycle. That's how we are approaching this market and this economy. I would love to open this up for questions. I think this is really all the content that I had. We still have about 10 minutes. So if there are any questions, please feel free to even unmute yourself. More than happy to discuss. Any questions? Let me see if we have any questions online. All righty, going once, going twice. Okay. Well, if there are no other questions, thank you so much for joining us this evening. I know we do these webinars a little bit later in the night. That way we can accommodate folks from the West Coast as well. Really appreciate everyone joining us on our monthly webinars. We'll be having one more by the end of this month. This webinar got delayed by about a week because we did have a cancellation from one of the guest speakers. But we will have another webinar towards the end of this month, most likely on the topic of legal aspects of real estate investing. So thank you again for joining us this evening and for your support. Oh, I see.
I have one question. Yes.
Yes, go ahead, please.
Sorry, it was just difficulty getting unmute thing.
Oh, no worries.
Well, this was great presentation. Thank you. One question I had was about the ticket size, honestly, right? You mentioned previously about, I think, tokenization or trying to get smaller ticket sizes. Did you make any progress on that front? When I say earlier, maybe 6 months back or something like that. I don't remember now.
Yes, you mean like the minimum investment size specific to real estate, right?
Specific to the projects that you're taking, but yeah, realistic, definitely.
Yes. So I would say that tokenization is not something that we have looked into, because that, sure, that is a benefit, because now you can get a lot of retail investors and you can really truly invest even $1, but it also gets equally complicated because almost all the deals that we do are regulated by SEC, and we have to file paperwork for every investor we have. Now, if we start taking investors for $1,000, you can imagine how many sets of paperwork and legal document, like just the legal cost to take in that investor will be more than the investor bringing in the capital. However, although we advertise, I'm not sure if I should say this, but since you asked, I'm going to give you honest feedback. So we advertise that $100,000 is the minimum investment in our deals, but we have taken less. People reach out to us directly. They're like, hey, this is the most I can do. Can I at least get in one of your deals so that I get my feet wet? I get some experience and exposure to real estate. I get to know you guys and how we operate. And if things go well, maybe next deal I'll put more. So many instances have happened in the past like that, and we are open to it. If that's a gesture of good faith and you're starting out your journey with a smaller amount of capital, because I know $100,000 is a lot of money. And in an economy like today, I can totally understand putting in that kind of money. It's pretty daunting. So to answer your question, we do accept much smaller check sizes than that. So far, the smallest that we have accepted is 25K. I think I'm going to get in trouble with Andy for saying this on a recorded webinar, but just wanted to provide.
I'm going to be in Cincinnati, by the way, twice again for next 2 months. So if you are available for 30 minutes, I would, I don't want you to say anything on the recorded webinar, right? But I'm trying to get my feet wet, just exactly as you said, right? And
absolutely,
that's why I had the question.
Absolutely.
I'll message you, and if there's a way we can meet up, that'll be great.
Would love to catch up in the next 2 weeks or so. So I don't have my phone number here, but I'll ping you my phone number as well, so we can get in touch and would love to catch up. Thanks, Juan.
Sounds good. Thank you.
Yep. Any other questions? All right. If there are no other questions, I think we can close this out about 5 minutes ahead of time. Mohit, I've pinged you my phone number, so you can maybe shoot me a quick text and we'll get in touch. Okay. Awesome.
Absolutely. Thanks.
Great. All right. Thank you again for joining. Enjoy the rest of your evening, and we'll see you on our next webinar towards the end of this month. Thank you, guys. Take care. Bye-bye.